We have learned in the financial statement analysis framework that there are 4 steps in the financial statement analysis for the purpose of understanding a business and to make the valuation of a business. So in that framework, we have learned that in the second step after the strategy analysis, we have to understand the accounting, and we discussed on the accounting analysis briefly in second lecture. We have learned that accounting has given us the privilege and has also given us the avenue to think from the accrual basis accounting other than the cash basis accounting. And when we follow the accrual basis accounting, it gives the avenue to have some discretion. And we have learned that accountants or the managers are given the authority to use their discretion, and accounting standard has provided this authority for some reason. One reason is that they have superior information about what is going on in the business. But at the same time, you also have observed that managers often misuse this discretionary power to misstate the numbers, so which makes the financial statement less reliable. And as a financial statement analyst, we need to look for these ways where managers have discretion, and we have to find out whether they have used it properly or they have not used it properly. So out of the basic accounting analysis, we now want to turn to the specific accounting issues in the balance sheet. And then in next class, we like to look at a specific accounting issues in with regard to the income statement. But before that, if you like to review the accounting standards, and if you like to review the extent of discretion given to the accountants, and what are the potential red flags in the financial statements analysis, I would request you to review the contents. Request is weak word. I would recommend you to review the contents you have learned in the financial reporting analysis, probably in second year, and you review the contents you covered in that course, and also you try to review the chapter before this chapter. Here we are now in chapter 4 of the Palipu text. You look at the chapter 3 for the things I mentioned earlier. So in this content, chapter 4, we are interested to explore the specific issues related to the balance sheet and how looking into the balance sheet in detail from the financial analysis perspective help us. So if you can find out the distortions made by the managers in the balance sheet, it will help you to identify any distortion in the financial statement first. And it will also help you that to understand that what are the economic consequences of the transactions the firm is making over time, and what is the difference between the financial position reflected in the balance sheet and the actual financial position of the company or of the business. So we need to have some accounting knowledge, basic accounting knowledge. And that will help us to identify whether there has been any distortions made in the balance sheet. So if we have discovered any distortion in the balance sheet, we need to make adjustment for the purpose of valuations, which is our uh, next task in this course. So right now we are in the part of financial statement analysis. So when we look at the balance sheet of a firm, we see the listing of assets and liabilities the firm possesses or the firm incurs, and we can make comparison of the balance sheet numbers in terms of ratios with the previous year ratios. And it will also help us whether there has been any significant changes or any numbers which need to be looked into detail to find out whether the management has misused their discretionary power. So first of all, we like to explore on the asset side of the balance sheet. The side is now misleading word because nowadays balance sheet has no side. Assets are written on the top and the liabilities on the bottom, and then the shareholders' equity. So left or right side is no longer used. So first of all, asset. So before looking at what are the potential pathways, how the asset value or particular asset is distorted, we need to remind ourselves what is the definition given in the accounting standards like IFRS about the asset. And this definition is standard definition, and we should not use any discretion in defining the assets because we need to rely on the accounting standards for these definitions. Management has not been given any discretion to define assets in their way. So the definition given in a standard has given us the ways that how an asset is need to be recognized. And these are this definition is commonly used in the accounting standards like International Accounting Standards, IAS. So which resources is to be considered as assets? So we know that assets are resources which a firm own and firm has firm control. These resources are known as asset. But in accounting standard, asset has been given a very specific definition. Assets are defined as resources which have probable future benefits. So, and the definition is kind of this asset should be owned and controlled by the firm. I mean, the economic resources which we are recognizing an asset needs to be owned and controlled by the firm. And we know that we are considering this asset because we are believing that this will provide some economic benefits in future. So we need to have capability that the future economic benefits of these resources can be measured with reasonable certainty. So these are some wordings from the accounting standards, and fair value of assets fall below their book values. So it is in general thing over time fair value of the assets come down, and for number of reasons it can be one of the common reason is impairment. The asset value come down unexpectedly for the changes in economic condition or for the changes in asset market. This reason, so it happens that fair value of the asset often go down over time below the book value. And when you estimate the fair value for the resources, that estimate is to be accurate. Now you see the distortion of the asset comes from misuse of this area. So here you see first that is this issues we like to explore in detail, because distortion arise most often whether the firm owns or controls the economic resources the firm is claiming. The firm is claiming these assets. So if the firm claims some resources as asset, accounting standard is saying you have to confirm these two things. You have to own the asset and you have the controlling power of the asset. And second thing, so you see if there is any issue with the owning and controlling of the economic resources, in that case, distortion will arise. Same thing for the second one, that the economic benefits which is to be generated in future from the assets needs to be measured with reasonable certainty. So this is a critical thing. It is not always possible. There are some ambiguities, there are some uncertainties, there are some challenges. So that's why it is not always implementable. So when it is not always implementable, distortion arises in this phase. And fair values of assets fall below their book value. And now you see that when the fair value of asset is coming down, sometimes you will see that fair value is not coming down. And if you see the fair value falls, but at what extent it has fallen, and how long it will sustain at this value, and when you need to recognize these are some issues. And this is a critical thing. It is a very difficult estimating the fair value. Estimating the fair value is a very difficult thing, but accounting standards looks for the accurate estimates of the fair value of assets. So let's look at these things individually. First thing, ownership and control. So ownership and control are two separate things. Usually when firm has the resources and the resources which is used directly by the firm, it is very easier to say that firm has both ownership and both control, both ownership and the control on these resources. But there are some companies which have resources under their ownership, but they do not have the control. They have the ownership, but they do not have the control. So, sometimes firm has control, but they do not have the ownership. So let me give you some example that when firm uses the leased asset, it happens frequently that firm uses some resources as a leased asset. So which leased property. So you know that in general, the leased property has been taken as a lease from the lessor. So lessor has a ownership, but the lease agreement can give the right to the leasee to purchase the leased asset after a certain number of years. So whether the leased property should be recognized an asset in the firm's balance sheet is often challenging because of this issue because of the gray area, whether the firm actually owns it or not. A firm does not own it. The firm which has taken it as a lease. So it is difficult to note, difficult, and what are the ways that manager can recognize the leased property as their asset? So they need to explore the lease contract, and managers have been given some discretion by accounting standard. At the same time, accounting standard has given some rules which are kind of mechanical rules. So you probably have come to learn about the operating lease and the financial lease. So there are some clear identification that 75% of the lifetime of the leased property, if it is covered in the lease period, say leased property has 4 years life, and the lease has been taken for 3 years for that property. And who will bear the risk of obsolescence, and that the asset will incur risk and asset will get destroyed, and who will take the risk of this? So usually the owner is responsible for taking care of the risk. So there are this criteria based on what I'm doing here. I'm trying to help you to get an idea of the mechanical rules given in the accounting standards. So this will help, this rule will help determine whether this is an operating lease or the financial lease. And when it is the financial lease, usually the owner is the firm which has taken the lease from the lessor. But we see that these are not often clear. These are not often clearly defined. I mean, the rules are clearly defined, but finding the things in the lease contract often needs careful examination. So managers have been given some discretion to think of whether they should recognize leased property as their asset, or they should not consider it as their asset. Rather, they need to take it out of the balance sheet. So other than the rules, managers have been given some discretion. Now, question is that when the managers have been given the discretion, it has been found that managers often use the discretion in unexpected way to have their objectives fulfilled. So what kind of object say, what does return on asset indicate? Write your responses in chat box. If I ask you that if ROA of a firm is doing great, what you will think about the managers? ROA is getting bigger over time. What would you say? Managers are using the asset efficiently. Good. So it is a kind of credit given to the managers. Now, if you see that by manager, you see that it is a bit, if managers in some way reduce the value of reported asset or understate the asset by removing financial lease from their balance sheet, what will happen? ROA will go up or go down? ROA will go up. So you see, for that purpose, managers are likely to use their discretion to understate the asset by declaring that they are not owning or controlling the asset. But if it turns out that it is a kind of financial lease, it has this criteria, you are aware of the other things from your financial reporting analysis course, you would see that managers have their, the firm has ownership or control, but firm is understating their asset by leaving this kind of financial lease out of their balance sheet to misrepresent the ROA. Okay, so next thing is economic benefits and its fair values. Okay, so an asset or some resources are considered as asset because it is believed that they will provide some economic benefits. So they provide some economic benefits which are measurable, and accounting standards require that these economic benefits should be measurable with reasonable certainty. So it is often difficult. For what reason? Say company has made a capital expenditure, and this capital expenditure will only considered be an asset if it is believed that this capital expenditure is expected to make some economic benefits in future. But it happens that capital expenditure, what the firm has done in this year, has become worthless. For what reason? Because the project for which the capital expenditure has been made, it has turned out that the project will produce something which no longer has demand in the market. It has been discovered after 2 or 3 months after the capital expenditure has been made. So in that case, the expenditure has already been made, but you see that it is very unlikely that economic benefits will be generated in the future for this expenditure. In that case, you cannot recognize this as an asset. So for various reasons, it can happen. So one thing we like to highlight, and often people highlight, that is the research expenditure. You see, research expenditure is a kind of cost. Often, research expenditure is considered, research expenditure has been made by the company, but it is very unlikely that research will give something positive. Because based on some expectation, research has been done. So out of the 10 research you have made for your company, if it turns out that only 2 research will give some positive outcome, and if it actually happens, you will see that out of the 10 researches, 10 research you made, 8 research has given no value. It has, say, you can think of some feasibility study or feasibility expenditures for feasibility study. But you see that you have made some capital expenditure. So you are very likely that you will show the expenditures made for 10 research as a capital asset, because you are expecting that the benefits of this research expenditure will be enjoyed for next few years or next several years. But a considerable judgment is involved whether this research expenditure will create value or not. So when the people use their discretion, I mean the managers use their discretion for overstating the asset, in that case, accounting standards always give us the rule that when there is a research expenditure, consider it as expense. So research expenditure should be immediately expensed. Research outlays, the amount you have spent for the purpose of research, should be immediately expensed. And research expenditure, purely research expenditure. But if the expenditure is a kind of something development expenditure, in that case, it can only be capitalized, the development expenditure, if it meets some criteria, some strict criteria, I would say. Say, in some industries, the development expenditure and the research expenditure is common. Say, software companies, the pharmaceutical companies, chemical companies. And you see what will be the economic benefits from this research or from this development expenditure is often uncertain. And when it is uncertain, you need some discretion. You need the use of discretion to consider it for the consideration of asset. So someone has raised question, if it is not asset, what is it called? The answer is if it is not asset, you need to look at if it is made as expenditure. In that case, say research and development, what I have I was discussing, that research is not has not been considered as asset. It needs to be immediately expensed. In that case, research will go to the income statement, research expenditure. And another issue, the lease asset, if it is not considered as an asset, on balance sheet asset, it needs to be transferred as off balance sheet asset. So these are some ways that how you can make adjustment in the balance sheet. The third thing, we need to follow the definition again. This one, fair values of assets fall below their book value. Okay. So accounting standards require that when you have non-current asset, you can use the revaluation model to reflect the fair value of the non-current asset. So can you give me the examples of non-current asset? Can you write the name of some non-current asset? Property, plant, and equipment is a classic example of non-current asset. Okay. So the comparison is in between cost model and the revaluation model. So you see, over time, what we need to do, the non-current asset, we need to look at their book value and their fair value. If it is observed that, let me explain it, that what we mean by the cost model. We see that asset is reflected as book value commonly in the balance sheet, and we make some depreciation over time for the purpose of usage, and so we need to subtract the accumulated depreciation from the book value of the asset to get the remaining value of the asset, and this is a practice of cost model. Here we subtract the accumulated depreciation from the capital cost of the asset, and it does not reflect the fair value. But when it is revaluation, revaluation has been permitted in the IFRS. If you see the fair value of the asset has gone up, you are allowed to make revaluation. So you look at the fair value, you make adjustment to the value of the assets and make a revaluation. Now, it can be often it happens, you will see in non-current asset, in a case of land or these things, you will see that revaluation increases the value of asset reported in the balance sheet. Now, as a research analyst, you will often see in the DSC news archive that company reports that net quarterly net after revaluation, say 20, before revaluation it is 15. So it is allowable, the revaluation, and you see for the purpose for the revaluation made by the company, you see the NAV has also increased. And if the opposite thing happens, other than the increasing of value, the fair value, you have observed that for the purpose of obsolescence, the asset has lost its value. And International Accounting Standards 36 indicates that if it turns out a non-current asset has a book value which is greater than the value which is recoverable. In that case, you need to make a impairment. You need to make impairment charges. So how the recoverable value is different from the fair value? Because you need to make some adjustment for the selling of asset, and you need to make some adjustment for making the transaction. This expense should be subtracted from the fair value, and then you get the recoverable amount. In that case, you need to make impairment charges. So what will happen? You need some write down of asset. You need write down or impairment of the asset. So you see that what companies do or what managers do. Managers, if they understate the depreciation, in that case, the book value of the asset in the balance sheet is inflated if they understate the depreciation. If they understate the depreciation, what will happen to the book value of the asset? It will be overstated. Yes, no? Yeah, book value is overstated. So when book value is overstated, for what purpose you are doing? You are not appropriately estimating the depreciation, or it can happen you are not appropriately recognizing the impairment. You are not appropriately recognizing the impairment. You see, if you do not do these things, what will happen? It will overstate the asset. And why you are doing this? Managers are often evaluated based on the EPS they are generating. You see, EPS is the final item in the income statement, and which is coming in a way which requires subtraction of depreciation, subtraction of impairment, these things. And managers believe that they want to show a good EPS in this quarter or in this year. They are likely to understate the depreciation and also understate the impairment charges. And you see that when you are comparing the book value with the fair value for the purpose of either revaluation or for the purpose of impairment, you need an estimate of fair value. You need an estimate of fair value. But compared to the market of current asset, the market of non-current asset is relatively more liquid or less liquid? In comparison to current asset market, non-current asset market is likely to be more liquid or less liquid? It is likely to be less liquid. So when it is less likely to be less liquid, is it easier to get a fair value? It is not easier to get a fair value. But accounting standards recognize requires the managers to consider the fair value which is accurate and recognition of the impairment or the depreciation in appropriate way when the book value exceeds the fair value. Okay. So another thing that how assets are overstated. So there are rules that how revenues will be recognized. Okay. Note that it is you can take the examples of understatement of impairment for this one, understatement of allowances. Okay. It is also possible to overstate the asset by accelerating, by recognizing the revenue in an accelerated way. There is a clear standard for recognizing sales. The way is that when the products are shipped to the customer, you can recognize the transaction as asset. But if it happens that the managers are recognizing revenue aggressively, how still the products are within the territory of the company, but company is recognizing sales. In that case, what will happen? The sales, if it is credit sale, which asset is likely to go up for this kind of accelerated recognition of revenue? If the credit sale goes up, which asset is likely to be overstated? If the credit sale is recognized, okay, accounts receivable, more precisely, accounts receivable. The sales is directly connected to accounts receivable. Now you see that you have recognized sale aggressively. It is likely that some of your credit sale will not be sold finally. In that case, the accounts receivable reported in the balance sheet or current asset side of your balance sheet is not appropriate. Okay, so it happens. The opposite thing, the understated asset. So I gave an example of this already. So sometimes companies transfer the leased asset or key intangible asset to off balance sheet. And what is the intention? Intention is that they want to show that they have generated a good ROA. One intention, there might be other intention, and they can aggressively discount their receivables to the bank. But if you see that if the accounts receivable discounting has a condition with the bank as a recourse, in that case, this account receivable will bounce back company. In that case, you will see that receivables has been understated in the balance sheet. Okay, so other than this, IFRS also gives some avenues for which asset is likely to be understated. And these are some examples of non-current asset and the current asset overstatement and understatement. Okay, so the final thing we like to share is that this is extremely challenging, accurately estimating the fair value. Okay, so there are some clear rules that how can you estimate the fair values. and it is often easier for current asset. So according to IFRS, we need to one example of financial asset. One example is financial asset for which estimation of fair value is more straightforward. That financial assets needs to be categorized into three headings: held to maturity, held for trading, and available for sale in this way. So held for trading, available for sale, this needs to be reported in the fair value. Held to maturity is not to be reported at fair value. But as financial assets have a liquid market, the fair value estimation for this current assets is relatively straightforward compared to the non-fixed asset. So in next class, we like to discuss on the liabilities and shareholders' equity.